Hello and welcome to Super Insider, a podcast on all things about the economy, investing, superannuation and retirement, proudly brought to you by Australian Retirement Trust. My name is Anne Fuchs and I'm your host today, and we are talking with our Chief Economist, Brian Parker, my partner in crime, as I always describe you.
Hello, Annie. Nice to see you.
Annie, I love it. Annie was one of my favourite movies when I was a kid. Annie, get your gun. Watch out. We're going to be covering all things of economy, performance and the like today. It's a big episode to start off 2025 when the year's gone off with the bang. Of course, before we do that, listeners and viewers, please remember that this is general advice and general information only. You will need to decide if it's right for you. Interest rates have just been cut, Brian.
Mm-hmm.
Silver bullet, yes or no?
No. If anything, it was described by economists as a hawkish cut. In other words, yes, I'm cutting interest rates, and then in the written material, but also with the press conference afterwards, it was pretty clear that this was not a straightforward decision. This was very much, okay, we've had brought inflation down considerably. We're prepared to take out a bit of insurance here and cut rates. But a lot of the tone was, but realistically, we still have inflation above target. The labour market is still very, very tight. Some of the more recent labour market data have just reinforced that view. And so I think it's quite likely that, we could conceivably go for some months without interest rates doing much at all.
Do you mind if we go back in time or step back in time like the fabulous Cher song that I love? When we started recording Super Insider was when, it was during COVID. Super Insider really took off because people were stuck at home. Let's just go back in time and remind people when that was all happening and you were tuning in listening, inflation had a 8?
You saw very high single-digit inflation across much of the developed world.
And we are now at a?
We are now have a 2 in front of it at the headline inflation level. The Reserve Bank's preferred underlying measure still has a 3 in front of it.
Okay.
Technically speaking, they're aiming for 2.5. Their own forecasts actually now show that they're expecting inflation to settle at around 2.7.
In 2025?
No, not in 2025, but further down the track, so over the next 2 or 3 years. And that's technically speaking, still kind of uncomfortably high. And yet despite that, they still chose to cut interest rates. I think they'd be very, very reluctant to cut again soon. I think the hurdle they'd need to jump over to justify another cut is pretty high.
Okay, it's a very delicate dance is what you're saying. Is there something that our listeners and viewers should be looking out for in terms of a signal, an economic signal that would trigger the Reserve Bank to consider actually cutting rates again?
Look, the two most important bits of information really are the inflation rate, particularly the underlying inflation rate, but also the labour market. So not just employment growth, but in particular measures of just how much slack there is in the labour market. And this, probably the best measure is something called labour force underutilisation, which is a bit of a mouthful. And that captures the percentage of the labour force that is either unemployed or underemployed. So these are people who are working part-time, they want more hours and they can't get them. So that rate is still above 10%, that combined rate. It has actually been falling. Which is not exactly what the Reserve Bank wanted to see. They wanted to see a bit more slack coming through in the labour market. It's stabilised a bit in the latest data, but really it's those two things. It's inflation and the labour market is crucial.
Okay, and that's what people need to watch out for. How does it relate to there are multiple asset classes that obviously are very, very sensitive to interest rates.
Yep.
Property is one asset class that our members just love. It's an Australian obsession. We all know it. So what's the flow on and so what from interest rate cuts in terms of our portfolios? Is there any?
I just think that, 125 basis point move doesn't make a lot of difference. It doesn't really move the dial in terms of our investment
But it's been
strategy.
a while. It's been a while. I thought it might have created a bit more excitement.
Not really, no. At the end of the day, we don't base investment decisions. We don't design portfolios based on the likelihood of a rate cut coming this month or next month or whatever. We think about it in terms of the longer term. We think about, what is the long-term level of interest rates? What's a normal interest rate for Australia over the very long term? Which tells us, and that really is a bit of an anchor. That basically says, okay, that means that over the very long term, what return are we going to get from cash? For example. And if we then decide, okay, we also invest in risky assets, so property, shares, infrastructure, all of those assets have to deliver a margin above cash. relative to and that margin depends on the risk of the particular asset. That's how we think about it. But we're not really too concerned or too obsessed with trying to forecast exactly what's going to happen to rates this month, next month.
And there may be parts of our portfolio where there will be opportunistic opportunities. That's a bit silly, but I think about we've just been recording Super Insider on location at Discovery Parks, one of the jewels in the crown in our property portfolio at Australian Retirement Trust, and they're wanting to grow and buy more land and upgrade their facilities. So all of these things, I guess, have a component of sensitivity.
If you see interest rates fall dramatically, and 25 basis points doesn't cut it, but if you see a substantial fall in rates, then that does mean that the cost of borrowing for a whole range of things goes down. And so in theory, people who are looking to borrow money to develop new property or develop new businesses, the cost of borrowing has come down. Correct. But at the same time, even those people need to think about what is the long-term cost of my borrowing? And it's those sort of thoughts, those sort of projections, which I think are more important from a business and investment perspective.
And these are the things that you and the team, Andrew Fisher, are thinking about in that longer-term sense in terms
very
of
much so.
How we build the portfolio.
Correct. We're very much thinking about what is the longer-term outlook for the global economy, for inflation, for interest rates? How's the world likely to evolve over the next decade rather than over the next 3 to 6 months?
Okay, so global economy, I will pull on that thread, sir, and go there.
Oh, no, we're going to go there.
We're going to go there. It's been a big start to 2025, particularly in the United States. There is a lot of curiosity from our members around what all of this means for their portfolios and the safety of their portfolios. There's a lot of geopolitical instability around the world. What is your advice? Well, firstly, just sum up where we're at in terms of United States and then advice to members around all the things they're going to hear on the news this year.
Well, firstly, the United States economy still remains very, very strong. You've seen very, very strong economic growth in the US now for some years. The labour market still remains quite strong. Certainly, we are in for a period of volatility. We're seeing that with trade policy. We're seeing it with geopolitics. It is a volatile world.
Volatility has always been a thing, really. It feels
I just think that this time, I think the best way I could describe it is, firstly, volatility is inevitable. Volatility also provides opportunity. So if, for example, we ever see a significant fall in equity markets for whatever reason, that's an opportunity to buy quality assets at a better price. So we take advantage of that. Correct. Our job is to focus on the longer term, but also the more we can, buy low and sell high, that is how you make money. And volatility provides you the opportunity to do that. The other story, though, is that especially in the United States, we need to distinguish between the United States politics and the United States economy.
And business.
And we also need to remember that the United States, regardless of what you see on the news and things like that, it is still the largest, most dynamic and innovative economy on the planet. And there is still enormous investment opportunity over there. And it is still a very, very sought-after destination for foreign investors going into the United States. You look at the amount of money that continues to flow into the US from foreign investors all around the world, you're still talking about a couple of $100 billion a year, and that hasn't really missed a beat for the last decade, despite all the political instability and uncertainty out there.
In my head, I can just conjure up some of the assets that we own in the United States, from the shipping containers to the build those family
multifamily residential assets. We own port facilities. We own industrial property facilities. We own infrastructure assets.
These just crack on, regardless of what the politics might be.
That's actually true. And in particular, take infrastructure, for example, where we invest in a number of infrastructure assets, including renewable assets. A lot of the regulation, a lot of the political and decision-making that influences those assets, it's state and local, it's not Washington. And so
that's interesting to know.
So we absolutely take into consideration political risk and geopolitical risk into our assessment of when to buy a particular unlisted asset or not. And in a lot of these assets, the regulatory environment is actually state and local, not federal.
So it's quite stable.
It is much more stable.
Okay, then the tariffs is the kind of the wild card probably that people are wondering about, whether that's going to create some kind of shock event in the economy this year. What's your view on that?
Yeah, and we don't really have a great deal of clarity as to where this is going to settle. Things change almost. It's a day-by-day proposition as to what's going to happen. As a general rule, higher tariffs, you increase the cost of doing business. It's a tax on consumers at the end of the day. It also means that businesses around the world rethink their supply chains. They rethink where they source product, where they produce product.
So it could actually create. You'll have countries around the world sort of
may
reshaping their
benefit.
economy and their manufacturing, and they may benefit from this.
Yeah, and I think basically the most obvious potential losers, if you like, it is bad for higher tariffs on countries like China, Mexico, Canada, etc. Yes, there is an adverse economic impact on those countries, but exactly what it means for the whole world is still decidedly unclear. It depends on how policymakers respond, depends on how businesses respond. I mean, Australia is a prime example. Our direct exports, if there's a tariff imposed on Australian exports to the United States, the US is nowhere near the kind of trading partner it used to be for us. For us, it's overwhelmingly China and the rest of Asia. Would there be an impact on the Australian economy? Yes. Would it be positive? No. But it's not a big impact. It's not the sort of thing that can derail our economy. One caveat, though, if you were to see a major downturn in China as a result of tariffs or whatever, that's more likely to have an adverse impact on Australia.
Because again, I'll go to our members who are watching the news, particularly those ones that are nearing or in retirement that are they're watching their number, or they've got their app on their phone and they look at it, and then they've watched the news, and then they're going, all right, is that something that's going to trigger my portfolio to drop? What does that mean?
Yeah, it's a good question. And it comes back to, I suppose the way I'd address it is twofold. One is for every member, the ideal investment portfolio is different. Every member, needs to look at their investment strategy and say, well, is this right for me in my phase of life, my appetite for risk, my long-term financial goals,
my income needs if you're in drawdown phase,
my lifestyle needs,
yes,
etc. If you're actually genuinely worried that a fall in equity markets could completely ruin your retirement, that may be a signal that it may actually be a signal that maybe you're taking too much risk for your phase of life. How do you actually resolve these questions? Well, ideally, you get on the phone to Australian Retirement Trust and you talk to one of our advisors who can help you actually talk through these issues and talk through.
Or if you have your own advisor, talk to them.
Or if you have your own advisor, get on the phone and talk to them, because this is what they're designed to do.
And I just want to call out too that it is important to actually speak to a qualified financial advisor. There's lots of stuff happening on social media and so forth, and barbecues and all of that chat.
I just think that getting professional, qualified financial advice is still a much, much better way to go than going to Dr. Google or whatever, or the financial equivalent of Dr. Google. Getting advice to make sure your investment strategy you have is right for you. But also, I suppose the other thing I would say is that if I look at the state of the world and you look at the volatility out there, there's an old adage that share markets climb a wall of worry, right? And over the past couple of years, I think it's fair to say that the performance of share markets has surprised everybody. I think that if I were, we were sitting here sort of about 2 years ago, with inflation still very, very high, interest rates going up, and I think the general perception amongst economists was, to bring inflation down, there's probably going to be a recession and there's probably going to be really bad for equity markets. That didn't really happen. Now, that doesn't mean that you're not going to get more volatility. Volatility is an inevitable part of being an investor. Markets are inherently uncertain, volatile places. But the reward for putting up for this volatility is a higher long-term return.
So let's go to actual performance. Yep. And obviously, I'm thrilled that we are number one over 10 years for high growth.
Yeah.
But high growth is growthy. That obviously then takes into account you are taking more risk. You're exposed to assets that are more volatile. But members would be thinking about, well, that's 10 years. What is the next year hold, and is the same horizon? What is the outlook? And I know you don't do the genie sort of.
I know this is where I say if I knew where the stock market was going to be on 30 June, I wouldn't be here. I'd be in my farmhouse in Tuscany,
body weight,
drinking my own body weight.
Chianti, we know.
Right, exactly.
We know, but come on,
look,
throw the girl a bone.
Okay, we're in for more volatility. I'm an economist by trade.
Yeah,
this is
you
what
said
we do,
that.
right?
Come on, give me.
But look, we are in for more volatility. I think the best way I can answer the question, which you're not going to be happy with, because I'm basically going to say the next decade is going to look decidedly different to the last decade. The last decade was an environment where a rising tide lifted all boats. Share markets did well.
Even though there was a
interest rates-
pandemic.
Even though there was a pandemic. There was a whole range of crises and
Yes.
mini-crises all the way, including a pandemic. But
So
from
why
a
do you say
financial
that?
because over time, I think we're going into a world where the world will be a more volatile place. Geopolitics, trade disruptions, this is all volatility. It means that the global economy, it means inflation is probably going to be a little bit higher than we've been used to. Interest rates may be a little bit higher than we've been used to. And so the next decade, I think, is going to be maybe a bit
the
more challenging.
settings are just very sensitive.
They're very sensitive. But one thing I would say, though, is if you ask, well, over the last decade, I was rewarded for taking risk.
Well,
Okay.
I didn't want to. That's exactly where.
Yeah. But over the next decade, am I still going to be rewarded for taking risk? Yes. The world has not changed that much. And so if I'm prepared to take risk, if I'm prepared to accept market volatility, the reward for me accepting that volatility is that I'm probably going to get a better long-term return by doing that. Doesn't mean that everyone should pile all the money into share markets, but it just means that, despite the fact that the world is an uncertain and volatile place, we're not in the business of hiding money under the bed. We're in the business of taking and managing risk on behalf of members.
In a very thoughtful, deliberate, well-researched way. And
a well-diversified way. So your best defense against not knowing how the world is going to pan out is to be very well diversified across asset classes, across countries, industries, regions, etc.
Brian, it might be useful for our listeners and viewers just to remind them that concept of the investment objectives, like what's on the tin. So when you're thinking about what you actually need to generate in terms of a return and the CPI component, do you want to just remind because we haven't spoken about that for a while?
That's good because, when you pick up the PDS and read it, firstly, you're probably doing really, really well because most people don't read it.
You're already tick.
That's
You're
a big
hero.
tick, absolutely.
You're a hero already.
Please read the PDS.
Yes.
Because in there, we put a real return objective. We basically say, look, over the next decade, this is what we're aiming to achieve. This is a return that we think is achievable and realistic over the next decade. So to give you an example.
After fees.
After tax. And after inflation.
Thank you.
Yeah, so it's the real return. The real or after inflation, after tax, after fee return, that determines what sort of retirement you're going to have.
Yes.
Okay. Now, for example, for a balanced option, we think that's about 3.5% above inflation. That is significantly lower than the return we've seen in the past decade. It's still quite a decent return, but I just think people need to accept that the next decade, I would much rather plan for a lower return. And you know what?
And be surprised.
Investing is like life in general. I'd much rather be pleasantly surprised than bitterly disappointed. So let's have a realistic assessment of what sort of returns are achievable and sustainable over time. For a balanced option, that is probably 3.5% above inflation. That's after fees and tax. And if we do better than that, great. But I think that's what people should be focused on. And anyone promising you or saying to you, you know what, we can do much, much better than that without taking any ridiculous risks, that person is either a fool or a charlatan or both. Run a mile.
And you're taking a lot of risk as a consequence with your very precious money.
Absolutely. There is no free lunch, right? So, you get rewarded for risk. Anyone implying that you can get really amazing returns without taking risk, that should ring alarm bells for everybody.
Okay, so headline for 2025 and the economy and investing at large.
Okay.
You're going to write the headline on the newspaper?
I'm not sure about the headline on the newspaper, but, I think economic growth continues. The economy continues to chug along. Yes, it's a volatile, uncertain world, but volatility is inevitable and it provides opportunity. And stay focused on the longer term. Recognise that super is the longest term investment any of us are really ever going to have. And if you are worried about what's going on, if you're worried about whether your investment strategy is right for you, please get on the phone and have a chat to us. Have a chat to your financial advisor. Have a chat to one of our advisors if you need to, because that's what they're there for. Bang on. And you can also play around on our website. There's some great tools and calculators, and we have a big catalogue of Super Insider episodes with some of our investment team, and also thinking about what is your number in retirement, because that also is a really, really, everyone's number is different. Absolutely. So thank you, Brian. Good to have you. You're most welcome. Wonderful to be back. It's great to have you back, sir. To our listeners and viewers, thank you for joining us on Super Insider. Tell your family and friends and subscribe to where you consume your podcasts, and we'll catch you again very, very soon.